All right, happy Monday. Happy Monday. For those that care, I finally bought chapstick. It only took 2 weeks, but I know there are people out there that are wondering, and I appreciate your concern. Cool. Don, I did get your invite for yesterday. I would, next one, I promise. Promise. Next Monday or whenever the next one is, I will be there. Anthony, guarantee, just can't do it tonight. And thank you for the continued invitations. All right, let's let everyone get in. Then we'll go into some stuff. And actually, what I think I'd like to do today is, what if we all started today, right? Like we all just met today. How would we go ahead and take a look at the market from a non-biased, but also a non-framed point of view? Like if you just got zapped here on Earth from Mars or wherever you may have been zapped from, and somebody had said to you, okay, this is the New York Stock Exchange, this is the stock market. Quickly learn it and tell me by the end of today what your move is going to be. How would you do that? You wouldn't have the benefit of the experience in terms of, well, it did this yesterday and it usually does this at this point, and the resume of, I guess, the resume of insight, the resume of experience to go ahead and lead you. But could you take a look at the market today and say, okay, I see what this is and I can do that? Because a lot of times we get caught up in the resume of experience, right? I've been around for this long and I've seen this before, but the reality is never anything happens twice. You know, history does not repeat itself, contrary to popular opinion, but it does rhyme. For instance, I saw Ben Bernanke this morning on CNBC at 6 in the morning, talking about what he would do differently. And it's quite comical, because when Ben Bernanke was the Fed chairman, he was the one that uttered the sentence, subprime is contained, don't worry about anything. And I'm adding the don't worry about anything part, but subprime is contained. Obviously, the implication is don't worry about anything. I'm not sure in the history of Federal Reserve policy, has there ever been a more incorrect sentence? Now, that's a bit unfair. I'm not piling on him. I'm not picking on him. It could have happened to anybody, blah, 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 which all of that I don't know to be true, right? Like I'm not the Federal Reserve chairman. But if you took a look at a single sentence, actually a single 3 words that was the most wrong in the history of economic commentary, he would have been the one that uttered it, and those would be the 3 words. Now, take it whatever you like, but that's the facts. So for him to now be on talking about other Fed Reserve members, it seems salacious to say the least, right? Like, I don't know if any reasonable person would say, oh, there's Ben Bernanke, he's been right so much, let's listen to him. In fact, one would say with a very cynical point of view that, oh, he's probably going to go down in history as the most wrong federal chairman. So it might behoove him to kind of point out that everybody makes mistakes. But that's just a commentary on something else. But the point is, even he would like to come to this planet from never being here again and starting right now. So I think we have everyone on. For those that are just joining us today, or for those that are just starting with the stock market, how can you actually take a look at it? How can you go ahead and make a decision? How can you come up with how could you form a action that you feel confident in if knowing nothing beforehand, right? So let's do that. I don't know where the market is. I think the last time I saw it, it was down 60. So let's just take a look. Let's just kind of peruse around. Let's see where it lands us. For those that have been with us for quite some time, know that volume, volatility, and price is our North Star. So that is what we're going to use. And that is something that if you were just here for the first time, we would say, this is, hey, greetings to Celebration Florida. We would identify those 3 points to make sense. So we're going to do that today. You just have the benefit of knowing what the definitions already are. So let's go share screen. Let's minimize that. Let's minimize that. Pretty sure I have stocks somewhere. We don't need E-Trade up. Let's move some stuff around. And let's see what's going on, right? So we just started with the stock market. We know nothing about nothing. And let's refresh. Oh, look, there's Ben Bernanke. Inflation was a mistake. Thank you, Ben. Which is actually really funny because during the Great Recession, they call it, right? During 2007, 2008, 2009. Not to get into retelling the whole story, but because there was so much leverage in the system and because no one knew where the leverage was, when things started failing, it started pulling money down black holes. Because something was leveraged so many times over, to be satisfied, it required all that money. But people leveraged more than they ever had the money for. So it took so much money out of the system, it was called deflation. It was the biggest deflation that we've ever seen since after the Great Depression. So for Ben Bernanke to be talking about the response to inflation was a mistake, well, Ben, we know what your response to inflation is. It's actually the opposite. It's like the pendulum swung the other way. You presided over the biggest deflation that we've ever seen. So, I mean, I guess directionally, he's the right person for the call. But in terms of the prescription, you actually could not find someone to be more unqualified. And I say that with respect. Ben Bernanke is a really, really smart person. Economics, there's many variables. And unfortunately, as a human, you're prone to confirmation bias. Like, for instance, this local community has unemployment of 5%, and McDonald's is out of business. One would say, well, if you only know those variables, you can say, with unemployment as high as 5%, even McDonald's can't stay in business. That would be a factual sentence according to the variables presented to you. But if we threw in other variables, now the conclusion changes. The point is, you can manipulate the conclusion by either A, manipulating the variables, and or only seeing the variables that you want to see. Then you can come up with your own conclusion. So Ben Bernanke is wildly smart. This is not a commentary onto his intellect. It's more of a commentary onto A, either his biases, or B, his inability to see other variables, right? Like, that's a fair sentence. And that's not a sentence of I'm more capable than him. I'm not. But that does not disclude that I'm able to make an observation. All right, so that's what's going on there. Ooh, Eli Lilly, that's an old favorite of ours, for the wrong reasons, but okay. Look at Twitter. So Elon Musk went ahead and decided that he's going to start playing a little shenanigans, and starting to say he's putting the deal on hold and stuff like that. So now the stock's down to 38. It's a real problem for Twitter shareholders, which is why we got in and we got out. We got our news and we were done. Which is actually also a commentary to don't ever let a trade become an investment. So for instance, say you got into Twitter when it was 51 and the deal price was 54. And you got into the trade saying, I think the deal gets approved and I'm going to, I believe upon that approval, the stock's going to go to 54. The difficulty with that is because you got in at 51, you're holding till 54, even though the deal did get approved and it didn't go to 54. So that trade, you're now saying is an investment. All right, you know what? I didn't get the price I wanted, but I'll just hold it till I get the 54. Well, that includes so many more variables that A, you didn't plan on having, and B, that you're hostage to. So a whole market pulling back and Elon Musk rightly considering, hey, listen, I could just not buy this thing, let it go to 10 or something and buy it there if I want to. That is variables that you may not have considered. But because those variables and because you held yourself hostage to those variables, the stock price is now 38 and owning at 51 down to 38, you're really quite upset. Okay, so let's go over to the S&P, right? Now, the S&P 500 is the 500 largest companies in the entire globe. We use the spiders, well, that's the name, because it's SPY is the ticker symbol. It represents the ETF, the exchange traded fund of the S&P 500. You see, the S&P 500 is an index. You can't actually trade it in real time. You can trade futures on it, meaning I think this index is going to be this price by this date, but the index itself doesn't trade. It's just calculated at the end of every day. But there is a product, an exchange traded fund, ticker symbol SPY, that trades second by second, that seeks to represent the real-time price of that index. So for those that say, hey, listen, I don't claim to be so smart that I know much about any particular stock past someone else who might have, say, inside information. But I do believe I'm smart enough to go ahead and grasp the macro economy, right? I believe I'm smart enough that if the earnings didn't go up, I could forecast that. And if earnings are going to go down, I could forecast that. Therefore, the best tool or the best vehicle to represent that forecast in a profitable way is the 500 largest companies, because if I could forecast their profits go up, then the index goes up because the stock prices of the majority of that index go up, right? So that's how the SPY is calculated, and that's the people that participate in trading the SPY. Meaning, if you wanted to get a big overall sense of the market, if you're able to read the chart of the SPY, you'd be in good position to get a sense of the market, right? So that's what we have in front of us here. So we always want to look at price. We want to look at volatility. That's not what I'm looking for. And we want to get volume. So price, volume, volatility. Now we're able to kind of determine, well, not kind of, well, I guess kind of, because nothing's an exact science, but if you could have the probability in your favor, two things are correct. One, you're going to be right more times than not, and two, you're not guaranteed to be right. I know that sounds a little counterintuitive, but trust me, it makes sense. Okay, so let's see where we're at. So right here, we see price coming down, right? What happened during that time frame? Volume went up. What happened during that time frame? Volatility went up. So when price is going down and volume's going up and volatility is going up, that's called like the worst case scenario. That's really, really bad. Because as people are selling, more people are selling. It's not less people are selling. So you're finding more sellers as the price goes down, and it's making everyone overly nauseous, pretty much, but overly cautious, overly volatile. So when this had abated, how do we know it abated? Well, price went up, but volume went down. Volatility went down. So is that something that's good? No, because as the price is going up, less people are buying. We saw more people selling when it goes down and less people buying when it goes up. So this volatility coming down is complacency. Enough people are out of the market that they're like, okay, yeah, I don't want anything to do with this. Just get me out. When the stock goes back up, when I can even get half my money back, get me out. I want nothing to do with this. There's something really bad on the horizon. Okay. So what happened here? Pretty much stayed flat, right? Went down a little bit, came up a little bit. What happened to volume? Pretty much stayed flat. In fact, as you can see this coming down, you can see the volume spike, and we'll get to that. What happened to volatility? Pretty much stayed flat, but when this started happening, that started happening, right? So let's go to that. Well, the stock started coming down again. So all of the people over here that said, listen, just get me out, something bad is coming, feel quite vindicated here. In fact, as the selling was here, you could tell that these people were telling these people, and again, we're creating a narrative, but it allows you to actually understand in a real-time way what is going on here. These people are telling these people, I told you, something bad's happening. Okay, so look how high that volume spiked, almost as high as this. And let's see what happened to volatility. Volatility went up as well. So price down, volume up, volatility up. But look at the volume. Does it look different than this? So when this was happening, volume was continually going up. When this happened, volume stayed even and then spiked up. That's what you call capitulation day. That's what our green bar tries to track, and obviously to a higher magnitude than this, because our green bar tracks when volume is 2.7 times trailing 21-day exponential moving average volume, which I understand that sounds a little confusing, but just know that it seeks to find this, right? It seeks to identify this. So what happens? Okay, this is so bad. You guys told me, you were right. I'm out. I'm never coming back in again. Okay. You see this bar right here? You'll see how it started. And I don't know if you can see this, right? So let me pull it out a little bit. These bars have a line on the left and a line on the right. The left side is where the market opened that day. The right side is where it closed that day. Hey, Michael, the left side is where it opened and the right side is where it closed. So let's put that back. Now, what you can see is it opened at the lows of the day and then rallied and closed at the highs of the day, meaning everyone that sold. Okay, so now what happens? All right, well, if all the sellers are out, the market goes up. But wait a second, it's going up on lower volume again. People are not interested in this market. In fact, as it's going up, the volatility is going up. That's not good. So as it's going up, volatility is going up. So people are still getting nervous as stocks are going up and less people are buying it. What does that predict? Okay, you guessed it, that we're going to come back down. Okay, so when we came back down, what happened? Finally, volume started coming down as stocks started coming down. In fact, as stocks came down, even volatility came down. Can you have more perfect of a setup? And no, because stocks are not selling off on higher volume and the volatility is not going any higher. In fact, because it's going lower, people are becoming complacent while stocks are going down in price. So the assumption can be made, all right, people are starting to see a tradable bottom here. And what is a tradable bottom? It's a bottom that allows you to have points of reference. So let's see where this bottom is, right? So when you take a look at this, you could draw a line across. Why? Because that's where it bottomed over here. That's also where it bottomed over here, and this got a little bit lower. So what a tradable bottom is, you could see at this point, all right, if it goes, let me just open this up a little bit. At this point, you could say, all right, I'm going to put my stop orders right over here at this low. And if it goes lower than that, I'll put a further stop order over here, or I'll look to buy there. Meaning at this stage of the game, I know my risk. It's down to here. I think this low is going to hold. Or I know my risk. I think this low is going to hold. Either way, I know my risk. So I can take a pretty much not free, but a very calculated shot going higher. Okay. And that's why the volatility went down. This became an opportunity. I can put my stop loss here, and if it goes here, I'll sell automatically. I could define my risk. But if it doesn't and it moves higher, then cool. You know, not free money, but high probability money. Okay, so what happens? Well, that was a good idea. Look how high that went up. That actually went higher than even here. What happened to volume though? Volume went down the whole way. But volatility went down the whole way too. Now, volatility measures complacency. So usually, and more times than not, when the stock market's going up, people become more complacent because the underlying reasons of the stock market going up are good. So stock market up equals good reasons, right? And when the stock market's going down, volatility goes up because usually when stocks are going down, they're going down for bad reasons, right? So that makes sense. But what if a stock market's going up because of bad reasons? What if a stock market's going up and there's bad reasons on the horizon? What if a stock market's going up and the volatility index is going overly complacent, right? And what I mean by that is when you take a look at this chart, you can see that these were the highs back in December. Now you can see this chart was barely able to break these, right? So when you take a look at reference points, you can see that this is the opposite of this. So you remember when we said, oh, this gave us a good point of entry, we know our defined risk. Well, opposite is the same thing over here. This is the former highs. So one can go ahead and say, all right, I'm going to short here because I don't believe this is over. I believe the economy is over leveraged and this is simply a relief rally. And I can tell it's a relief rally because no one's buying it. The volume's going down. Therefore, we believe that the next move is going to be lower. And because we believe the next move is going to be lower, we want to short the market. But what if the market keeps going up? We don't want to lose money. So we're going to put a stop loss over here or stop loss over here because you have all these various levels. See how much, see when it came down, there was not much trading. There was bing, 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 bing. Over here, you have a whole lot of trading, right? So for 3 months, you had all of this trading. So the stock market has a lot of people in this area that either are saying, if it ever gets back to where it was, I can't wait to sell, or have people in this area saying, oh, darn, I can't believe I lost all that money. I'm just going to hold it. Like, I don't care. It's in there. It's long-term. It'll be fine. The point being, because there's a majority of people in here that are likely scared, they've seen all their money come down to here, get me out if it ever gets back to where it fell apart. And you can see it fell apart here. There's a lot of sells that happened here. And because the sells happened here, you can see it. So look at the stock market. Goes down all that way. What happened to the volume all that way? It went up, right? It went up that whole time. What happened to the volatility all that way? It went up the whole time. So that's how you can kind of tell a story, and that's how you can confirm at least the science of price, volume, volatility. Now, of course, you have to put a narrative to it. So maybe that's the subjectiveness. That's maybe the variables. Maybe that's the being hostage to what you hope. That's why we started off today by saying, listen, we don't hope anything. We don't know nothing. We have no position in the market. We're sitting in just cash. If we came down to earth from Mars today and just saw the market, what would we do? I don't know. Let's find out. So let's take a look at 4-hour bars. Now, what we're seeing here is daily bars, but because it's not enough days for us to get reasonable data, because it's just not enough bars, let's go to 4 hours. 4 hours represents half a day. So it's still a sizable sample size. It's still half a day. It's not like someone trading hourly, but it allows us to see where we're at. Okay, so where are we? So let's draw the lines. The market has been going up over this 4-hour period. Volume has been going down. Although this last bar, again, do not be distorted by it. This bar represents only the hour the market's been open. So of course it's lower volume. So we can't see that just yet. Volatility is going down. So prices are going up, volume's going down, and volatility is going down. We saw that before. The market's getting complacent, but we can't exactly make that call just yet. We have to see what this volume ends up being. Because if this volume ends up being higher than these volumes, then the market's going up on higher volume and the volatility is going down, which would actually be an all clear sign, at least in the short term. So this bar is so important because if it is greater volume, we can say short-term bottom, buy. If this bar stays lower, then we can say short-term top, sell. It's all in that one bar. Now, what allows it to be a self-fulfilling prophecy, because I understand to a certain, probably to everyone, Anthony, that sounds cuckoo for Cocoa Puffs. You're telling me this 1 4-hour bar has that much power. Don't you think you're reading a little bit too much into it? So I actually agree with all that. I do think I'm reading too much into it. But because the stock market, all of the participants are all looking at the same thing, all the participants play by the same set of rules. Every single person knows 8 out of 10 times, if this happens, this happens. 7 out of 10 times, if this happens, this happens. 3 out of 10 times, if this happens, right? So if everyone is looking at the same thing, then conceivably, there's a large population of market participants that's watching this bar right now, which means if this bar does either a greater volume, then it is conceivable to say, because the market participants all will look at that as a buy signal, that the market will go up, proving that it was a worthy buy signal. Now, you might argue, well, Anthony, they all bought because they thought it was a buy signal, and because they bought it ended up being a buy signal. I'm not debating how lunatic and how lunacy that sounds and how manipulated that sounds, Anthony. It only went up because people thought it was going to go up, hence it went up. It's like, for instance, if you think you're fat, then you are fat. Even if you're not fat, but if you think you are, therefore you are. It's the same exact thing. It's a self-fulfilling prophecy. So we're going to take a look at it. Now, as it pertains more towards longer term horizons, like holding things for at least a couple of weeks. See, because these are 4-hour bars, this can prove to be a 4-hour bar signal. Meaning, if this is a buy signal, it's a buy signal on this chart using this 4-hour bar. Meaning, if we typically buy something and hold it for 2 weeks, this is half the time frame. That means you got to be prepared to get out of it within a week or less, which is a really difficult time frame, which will require you to be like watching the computer all day. So we're going to allow this to inform us on what is happening micro short term, like really, really in the immediate term. But what's more important to us is taking a look at this daily chart so we can see, all right, do we at least have some legs? Do we at least have maybe a week or 2 or 3 of a direction? Now, to that point, I want to show you one more thing. So what we see here, this is a weekly chart, which means each bar represents a week. Excuse me. And what you can see in this weekly chart, so let's clean it up a little bit, right? Okay. I wish there was a way to just delete all of this, which I'm sure there probably is a way, but the fact that I haven't discovered it yet means that if I look to discover it now, it'll likely take longer than just deleting them one by one, with no guarantee that I find it, meaning the risk reward of looking for the delete all function is not in my favor. And I say that out loud just to give you a certain sense of how my mind works. And that doesn't mean that the way my mind works should be the way your mind works, or should be the way anyone's mind works. But it is important to know how my mind works, since I'm the one presenting, and I'm hostage to my own confirmation biases. So I try to give you as much data as possible in terms of not only the research we provide, but also the person that is processing the research. So you can say, oh, well, I know Anthony said this, but I also know how he got to that because he also thinks like this. And I fundamentally don't agree with that line of thinking. Therefore, that research I don't agree with, right? So when you're able to do that, it's even better. So what do we have over here? So this is the COVID bottom right here. And when we draw this, let's see, here's the line. We can see that this was 2 or 3 standard deviations from this trend line. And how do we know the trend line? Because you can see it held trend, held trend, held trend. Once it broke trend, boom. So now we're in a downtrend. Okay, this is the top. Where's this downtrend going to reference points? Okay, why do we pick that? Because it's that top, it's that top, that top, that top. So it just seems like it makes sense, right? Now that bottom seems like it's kind of in no man's land a little bit, but maybe it's not, right? So maybe if you bring this across, so you'll find some reference. So you could see some tops here, some bottoms, but you could see once it broke there, it never looked back, and vice versa. So you could kind of get to the point that we're getting somewhere quite important. So how does that work with price volume volatility? Okay, so price is going down here. Volume was also going down here, right? Well, actually, no, that's wrong, because we got to do it from this bar, right? So if we take a look, where it stopped going down was here. Okay, so price down, volume up. Oh, we have all these lines too. How annoying. Oh, come on. We're almost there. Like I tell my son when he starts crying in the car, we're almost there. We're almost there. But I do my best never to lie to him, so I won't say that unless we're almost there. And I respect you the same way, and see we're there. Okay. So at this line over here, we see that volatility also was up as well. So price down, volume up, volatility down, not good. Okay. So now we see over here, price up. What happened to the volume? Well, the volume stayed consistent, stayed flat, so that was good. But then by the time it got up there, it came down. And what happened to the volatility? It came down as well. So you had price going up, but volume going down and volatility coming down. Because the volume did not go ahead and confirm that the price going up was real. And what do we always say? The volume is the lie detector test for the market. Because the market price is a number. The amount of people that participate in the market price is truth. So if only 2 people are in existence and 1 person, so say for instance, our town has 2 people and I go ahead and have an apple and the person that wants the apple really loves the apple. And I say, I will sell you this apple for $10. And he says, okay, great, I'll have it for lunch. It sounds like a great lunch, here's $10. Is the price of the apple, is the market price of the apple $10? The answer is yes. Do you believe that the market price of the apple is overinflated because of the limited amount of market participants? Yes. So when less market participants are there, the price is not as accurate. When more market participants come in, the price is accurate. So volume equals truth, price equals a number, okay? So what happened here? The market went down and it's been going down, okay? What happened to the volume? The volume's been going up and it's going up, okay? And volatility's been going up, okay? But something interesting happened here. So what we can see is in the last 2 weeks, price is up, volume's down, volatility's down. Now, when that occurs, we normally see at least a couple of bars worth of relief, right? So we saw it here, 1, 2, 3, 4. We're seeing it here. We saw it on the previous charts as well when it was just dailies. What that would suggest is you're at a near-term bottom, that the remainder of the month of May and even to the beginning of June is going to be a market that's going to levitate higher. Because especially as summertime comes, the really, really rich people, the ones that manage very large portfolios are like, you know what? I have this like $100 million beach house. I have a family. I work my tail off all day. And don't kid yourself. Rich people did not get rich by accident. And I'm not rich, but I can tell you that they do the same amount of work that I do. And I do as much work as anyone you're ever going to meet. Because I do want to get there at one point. And when that day comes, which I hope to be actually by the end of this year, and someone says to me, oh, can't believe your life, you're so lucky, I'm actually going to hit them. More so over the recent couple of occasions, because this last month has been overwhelming, not difficult, overwhelming, but I'm uniquely qualified to continue. But there's different parts of your life that spout out all over the place. So when someone tells me I'm lucky, I'm going to give them a little friendly knock in the head, right? That being said, this, and again, take this with a grain of salt because I'm hostage to my own confirmation bias. Now, mind you, my confirmation bias is purposely as neutral and as unbiased as possible because I'm presenting data and research that we're doing in real time together. But that does not exclude that my conclusion can be something that is pre-framed from variables that I don't even know, right? Like maybe one of these things I've been reading wrong my whole life, and I don't know it yet because I'm reading it wrong still. That being said, I'm operating under the assumption that I'm reading everything correctly and I'm being non-biased as possible, with the bias meter being at 0. I believe that to be true, but that's the definition of confirmation bias. You don't know that you're biased, right? Like you just don't know it. That being said, I submit that to you as like a warning, right? But it's in my non-biased opinion that I believe the next couple of weeks are going to be higher. So if that's the case, you want to start taking a look at things that offer you an opportunity to buy. Okay, so this is our super duper list. And I also want to submit 2 more things to you. The 2 stocks that I believe are being watched more than any stock in the entire market, number 1 is Apple and number 2 is Netflix. Number 1, Apple being because it is the biggest and greatest company, I guess you can say all time. So right now it's the 2nd largest company in the world behind Saudi Aramco, just an oil company in Saudi Arabia. I think it's probably like their entire oil reserves in one company. And I don't know that to be true, I'm making that up, but I just think that's what it is. So that being said, that kind of sounds like a sovereign thing, right? Like all of our oil fields are owned there because we're Saudi Arabia. And again, I don't even know that to be true, but I just feel like the freedom in business in America allows America to be far more competitive, right? So I believe the 2nd biggest company in America is better than the 1st biggest company in Saudi Arabia, especially when that 1st company is oil, because oil is a commodity that the price is outside of anyone's ability to manage. So I'm going to say the 2nd largest company in America that has to deal with business cycles and has to constantly adapt is more important of an indicator than the largest company in Saudi Arabia that is completely dependent on the price of something they can't control, right? Okay, so that being the case, Apple, let's take a look at the Apple chart. Do these charts look a little different? So let's take a look at the spider again. Okay, up, and it's breaking down, right? So you can see from here to here, let's move this. Actually, so you can see, where is what I'm looking for? So you can see from here to here, it's down 20%, down 95.41. For Apple, you can see down 24%, which is actually more than that. But that's actually probably not the correct. So you got to take a look at the NASDAQ where Apple trades. I mean, and Apple is the largest in the S&P too. But the NASDAQ, you can see the drawdown of 30%. Now the S&P is a drawdown of 20%. But you also got to remember the S&P is not just technology. The reason why I'm using the NASDAQ chart is NASDAQ is technology. So apples to apples, apples to apples, Apple's the best performing big tech company in the NASDAQ. So it is the leader. In terms of the S&P, you have financial companies, you have healthcare companies, you have oil companies. So the 20% drawdown in the S&P, which is still commensurate with Apple, 24 and 20% are not far from each other, is being buoyed, being held up by a lot of other things like oil. So when you take a look at the NASDAQ, that's a much more fair comparison. The point of the story being, take a look at Netflix. So when you take a look at the Netflix from top to bottom, that's minus 76%. That's really, really bad. But Netflix is a company that everybody knows. Everyone has Netflix at their house. Netflix was just almost $706. So you have to believe that if you're a big money manager, or if you're an investor, or if you're anything of the above, you say to yourself, okay, is the stock a large company, like a big cap? Yeah, Netflix is a very large company. It's not as large as it used to be, but it's $85 billion. Okay, so 85 billion is a lot of money. Is it something that everybody has? Like, is it a verb? Is it a noun? Netflix, I'm gonna go on Netflix. Let's go Netflix and chill. Yeah, it's both of them. So it's in the common vernacular, it's cultural. Is it down 75%? Yeah. All those things together would lead one to say, all right, it's down 75%, it's still almost 100 billion, and everyone is a subscriber, everyone's a part of it. When do I go ahead and buy it? Because if it's down 75%, do you think it's going to go down the additional 25% to zero? I think there's more likelihood that it'll bounce, but where does it bounce? I don't know. The point is, when the decision's made, and by decision, I mean, you'll see it start moving higher. That's because large money has said, you know what, we feel comfortable right here. Now, that's a Netflix opinion, a commentary. We believe the company is going to stop going lower, but it's also a commentary on the market. We believe that in a market that's going to move higher, that it allows more people to feel confidence to take the chance and buy something as large as Netflix down as far as it is. Meaning, we believe that Netflix is one of the two best indicators to whether the market's going to go up or down. So you see it's higher than where it was last week, good, but last time I checked, it's Monday morning, right? So that's not exactly a reliable indicator. But for those reasons, we believe Netflix is worth watching. Same thing with Apple. Apple is the largest company in the United States. Apple single-handedly has produced the best innovation, the best numbers, the best growth. I mean, their margins are still, I think, like 40, 50%, which is you would think a company that's doing hundreds of billions of dollars in revenue would have to eventually lower their margins to scale to more growth. But no, they get to keep their margins because people that buy Apple products, know that they're the best, so they only buy Apple products. And once people try Apple products, i.e. they only buy Apple products, so they're able to keep it. The point being, by any determination, by any metric, any logic, Apple is the company that you want to own for years to come. Meaning, people don't look at Apple as in, hey, I want to buy Apple because I think I could trade it next week. People look at Apple as, okay, finally, I'm able to buy Apple. I can't wait to see what this is in 10 years, 20 years. I'm going to buy my son a share of Apple every single day for the rest of his life, right? Stuff like that. Meaning, when Apple goes ahead and forms a bottom, where is this? It's going to be because the market is forming a bottom. So when you see Apple, which is now 145, let's say it gets back over this line, which is 150. So let's say it's trading comfortably over 150 for, I don't know, 2 or 3 days. One can then make the presumption. So if Apple's over 150 and Netflix is over 200, and they're both over those prices for, let's say, 3 days in a row, I would be comfortable saying all clear, buy. That's how important these two companies are, because of the reasons people would buy both of them are very different. For Netflix, it's, I believe the market's going to be so well that people are going to be able to A, take a chance on this, but B, their business is going to get better because the worst is behind us. Let me take a chance on something speculative that was just a $400 billion company 2 months ago. Apple is, I want to own this for the rest of my life. I don't necessarily care if I get the bottom, meaning people are actually even inclined to buy Apple and lose a couple of dollars. Meaning that when they start doing that, they already know they're already tolerating that the market might go down a little bit. Meaning the buys for Apple do not predict the bottom, but they predict that you're near the bottom. So if you have Netflix signaling all clear and Apple signaling the worst is behind us, well, that allows market sentiment to infuse the entire market. Because remember what I said before, self-fulfilling prophecies. When others see that, they then say, okay, I'm comfortable putting more money in. Let me get my stop losses. Remember, I'll put a stop loss on Apple at 145. I'll put a stop loss on Netflix 190. And if I'm wrong, so be it. In fact, I'll put a stop loss on my S&P by putting a stop loss on my Netflix. If Netflix goes under 190, then sell S&P. There's a lot of really cool things one could do when trading stocks, but these are the two most important companies in our opinion. Now, I will go ahead and submit that this right here, which is the Swiss franc. Now, Switzerland, right? Like you've heard, oh, they have offshore accounts. I bet you're hiding your money in Switzerland. It's because Switzerland is the most friendly banking laws in the entire world. Switzerland, who's never made an enemy their entire life, is the banking solution for any large person that wants to hide money, put money away, whatever. The reason being that Switzerland will never, that's what they're known for. That is who Switzerland is. They will never go ahead and, oh, the US, you're requesting files from us, kick rocks. Like, they will not submit to anyone. They will protect your banking information more than anything. Meaning their largest export is banking. And that's a very, very stable business, meaning that their economy is very, very stable. Meaning inflation and deflation and raising rates and lowering rates aren't exactly a normality in Switzerland like they are in other countries. Because that their currency is always deemed to be the most valuable. The Swiss franc is the gold standard in currency. They don't inflate it. And more so than that, they have the whole world's money. So it would behoove the world to say, okay, they have our money. It's in Swiss francs. Let's go ahead and protect and make sure the Swiss franc doesn't get hit because they have all of our secret money or our billions or our trillions of dollars. So it's also mutual assured destruction, which for every different reason, the Swiss franc is the gold standard in currency. Okay, and what you'll actually see is it's also a really, really stable currency. So let's pull this out for weeks. And what you'll see is that it's relatively stable. I mean, this is during the, so actually that's really important, right? Just to go ahead and further express my point. This was during the financial crisis. This is the market low in 2009. Do you see what happened to the Swiss franc during that time, where it was America that was blowing up? It was American financial system. Nobody knew what was happening. What happened to the Swiss franc, though? Everyone put their money there. So just to go ahead and further demonstrate, when people don't know what's going on, when they're fearful, the Swiss franc is the safe haven. Well, I'm really happy I was able to show that because it perfectly illustrates what I was trying to represent. And as you can see, during this entire time frame, it has stayed relatively consistent. It has this channel that goes up a little bit, down a little bit. Okay, cool, right? This channel is over 10 plus years. Okay. Now, what you can see with this channel, and let's actually make it accurate, right? Is that once it broke out of this high, it held here, a little bit. And then once it did, it spiked really high up. Held here, spiked up. Broke a little bit over here, but not by much, right? So you can even go as far to say, it has two levels of support. Here, 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 a bunch of stuff here. Okay. Where are we now? We're over here. Now, for a couple of different reasons. One, war in Europe does not help anyone in Europe. In fact, war in Europe is probably costly. I imagine the people that are paying for this war, like Russia, probably have some money they need to get out of Switzerland to fund the war. That's not something you're going to read in the newspaper, but that's what the chart tells me. There's money coming out of the Swiss franc. How do I know that? It's selling. But is that money coming out of Swiss franc a commentary on the gold standard the Swiss franc is, or is that a commentary on immediate variables, right? Like, oh my God, there's a war. We have to get our money for the war. Now, is that going to last forever? No. In fact, one would say war happens and then it ends. And when it ends, you go into peace times. So if this is a commentary on the war and needing to take funds out of Switzerland, what's going to happen when that's over? Well, this goes higher. Also, because there's war, all the money in Europe is going to safer places, i.e. the US dollar, which is the safest currency in the entire globe. So all of the currencies in Europe and across the whole world are coming to America. Is that something that we believe is going to be forever? No. So when does that end? We don't know. But is the Swiss franc unable to compete with America? No. In fact, the Swiss franc, when America wasn't doing well, was the alternative to America. So one could say, well, if America is the best reserve in the world, well, how come when America had a cold, everyone left them? It just is perceived that America is strongest now because they are. For all those reasons, we believe the Swiss franc is maybe a generational buy. To own it here seems like a really good idea, but we don't know how low it goes. When we go out and pull our algorithm and our daily indicators, so how many times have we seen a 20 red and green and we get like super excited, right? Have we ever seen a 30 red and green? Now, I granted this is not red like that, but stay with me. Even 28 red and green, but 30 red and green. Have we seen that? No. Now, this is the MACD lines. Basically, in not layman's terms, but in simple terms, it's retail money and institutional money. When this red line crosses up, that's more institutional than retail. And when it crosses down, it's more retail than institutional. And when there's more retail than institutional, it means the smarter people are out, or not smarter, because I really don't think people in finance are smarter than regular people. The more experienced people that can see what's going to happen, or they're the ones creating it, pull out. Does it look like that this is closer to crossing up than down? I would say yes. Red, green, how many times? 30, that means for 30 consecutive bars, the closing price is lower than where it was 4 days prior, 4 bars prior. So I don't know. I don't trade currencies. I did say to you that I was going to learn currencies. Easier said than done. This weekend's been long. For those that I've been on the phone with, you are very familiar that I've been on the phone nonstop. And we hit all of our goals for Rhino in terms of our fundraising, and now the coin is off the market. So everything is going well. But in terms of 30 red and green, now this is the ETF, FXF, 29 red and green. This you can purchase like a stock, right? You can just buy FXF like it was Apple. This is the actual currency, so you have to open a currency account. So if you said, all right, you know what? I want to go ahead and participate in this. This is slow money. This is the value of the Swiss franc. I want to go ahead and put, I don't know, some of my cash in Swiss francs, but what am I going to do? Hold Swiss francs? No. You can buy this, and this replicates the performance of Swiss franc. So we like that idea. In fact, I might even go ahead and do so for our son, because this is slow money, and a year or two from now, I think this would outperform than regular cash. So as we go down the list, we see we have a 23, not red, but green. We have an 18 red, not green. We have a 17 red and green, 17 red and green. So if the market decides to turn around like we're waiting to see, you have a lot of things here that are on the buy list. And we went ahead and took note of XLY and XLRE because these are actual ETFs. XLY is consumer discretionary and XLRE is a real estate ETF. ETF being exchange traded fund, which means it owns other stuff in it. This is the exchange traded fund for all consumer discretionary. So it's like 100 different companies that are within this ETF. So when you have an entire group of companies hitting a 15 red and green, it's safe to say that the market's getting like really, really beat up. Because when 100 companies collectively all hit that in average, when we can't even, what do we find, like 7 or 8 companies here that are better than 15 red and green? This ETF, the entire index is worse than it or better than it. So we're seeing a lot of things that are allowing us to believe higher, but we can't confirm that. In our commentary tomorrow, we will go ahead and attempt to confirm it by offering you a follow-up research on that 4-hour bar, Wow, we have a lot of people. It's so funny because when I'm doing shared screen, I can't actually see the number of people that are participating, but might be the most ever. And Esteban, I did get your call request. I know you have it booked. I forgot the day, but I'm totally excited for that call. I just want to confirm with you. Deborah, loved our call yesterday. We were cracking up like little kids. No, that was Saturday. Let's see, any other commentary? Love everyone. Laura, absolutely love your novels. I think your last novel, I'm not sure that I replied to. I replied very few to it, a simple answer. I'll go ahead and double check it. So for those that don't know, my friend, who I'm not going to out this person, will write me novels. We joke about it because it'll be maybe 7, 8, 9 paragraphs, and they're all like very, very important. It's almost like going grocery shopping when your house has nothing in it, instead of going each couple of days. So it's never that any of it is less important than other of it, but when I see it, I know that this is going to be a great read, and it's going to be quite comprehensive too. So that's it. I really, really love everyone. A lot of good things. Please go ahead and attend our Rhino Street Wednesday, 2:00. I'm going to be rolling out our new reward program and putting some color to it, why it exists, and how it's going to single-handedly be the golden nugget that So last week, I took 76 calls from Monday to Saturday. 76 half-hour calls. Some of them went over a half hour, whatever. In those 76 calls, it wasn't, hey, I'm Anthony, I'm Rhino Street, you need to do fundraising, bop, 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 give me $10. No, give me 20. No. The calls are, hey, what's up? We're checking in. Talk to me. How's life? How's this? How's that? Offer me some advice. This is what we're doing. They're all quite comprehensive. They're all, really involved. And there's many reasons for that. One, I think it's common courtesy. Two, if you tell people you value them, you better be able to back it up with action, which anyone that's ever spoken to me knows I don't shut up, right? Like it just happens. But thirdly, when you go ahead and truly, truly value the people that make you and the partners that create what you're building, it's quite important to go ahead and allow them to feel the comfort and empowerment to share what their advice is. And in doing so, without fail, the majority, I would say probably 65 of the 76, all went ahead and said the same sentence to me. I can't wait to start listing. I can't wait to start suggesting the Main Street businesses in my town. I cannot wait to start listing all of them. They're going to love it. And the coolest part about that is when you actually calculate that, right? So such an overwhelming number of people want to go ahead and pursue this behavior. That's very good. Now, how does that behavior, how does that motive, how does that insatiable appetite to do so fit into Rhino Street? Well, if Rhino Street is a localized search engine, it actually is quite important. It's actually crucial that the people of that locality go ahead and participate in recommending other businesses, because in no way, shape, or form am I going to be able to email every single business in every kind of locality. In no way, shape, or form am I going to know every business in every locality, because most businesses don't have a storefront. So how do I even know the digital businesses? How do I know the starting in your basement business? I won't, I can't, unless I'm able to motivate the participants of that locality to pitch in. Well, I only know that because the participants of that locality are telling me that they want to pitch in, that they really truly have embraced that the entire Rhino Street is a partnership of all of us and we're doing it together, which means that's the single biggest component to everything that we're doing. And it's now my job as leader of Rhino Street to go ahead and say, all right, we have this behavior, we have this goal. How do we incentivize it? How do we empower it? How do we reward it? How do we nurture it? Because this is everything that we need. So wait till Wednesday, right? So we're rolling that out. I'm still thinking further incentives, because like anything else, like the NFL draft, right? For those that don't know what the NFL draft is, NFL is football, and the draft is when the teams get to pick the college kids that are coming out of college to go ahead and be on their team. And obviously they do their homework and see who's really, really good. And there's usually a consensus who's the best. So you pick them, and the order you pick is in reverse order of your standing. So if you're the worst team, you pick first, so it allows parity. The point of the story is, there are some times that you think someone is far better than other people think. Like the Giants a couple of years back with Daniel Jones, the quarterback that they selected. Now, mind you, they were wrong, but he was easily going to be a second-round pick, meaning that they had time to come back to him. But they believed in this kid so much that they said, yeah, we believe we could get him tomorrow, but what if we can't? We believe that this guy is going to be the answer to our team, and we don't think we should take that risk. We think we should do everything and take him now. And they took him with the 6th pick overall, which everyone surmised and offered commentary. I can't believe they did that. This is crazy. This is like the worst pick. The GM's going to lose his job. They better make sure this kid is great because you risk so much on him. The point was, because they identified who they believed to be their golden nugget, who they believed is the answer, it didn't matter what it cost them, because the cost was always going to be less than if they were correct. The same, I want to share that analogy with you because that's the reward program we're going to make for Rhino Street. It's going to be so overly incentivized, so overly generous, because if I see the answer, that you guys have given me the answer, that we could together as partnership understand and identify the answer, it does not benefit Rhino Street as all, or me, the steward and the leader of Rhino Street, to go ahead and say, yeah, well, since they already want to do this, let's give them like 10 coin for it. Like, we'll reward them, but why am I going to overly reward something people already want to do? That's the wrong way of looking at it. Just like our team members, our salaries on the Rhino team are higher than national average. They're actually far higher than comparable jobs, right? And I know that, our team knows that, but I go ahead and show them that not only do I value you, I believe you are worth this. And because I want you on this team, because it means so much to Rhino for you to be on this team, I'm willing to stick my neck out there and go ahead and pay a cost that you might think is too high, others might think is too high, but me being right about you means I'm actually getting a discount, because you being what you're ultimately going to become is worth far more than any dollar amount I could put on it. The point being, the reward program we're going to roll out Wednesday is going to be obscenely incentivized and rewarding of the Rhinos. Because I think what you can see right now is, if I'm right, and again, I've spoken to every single person that, now mind you, we have over 1,100 Rhinos, right? But the 76 represent those that either are really, really well versed in Rhino and are looking to invest further in Rhino, or those that are uninvested in Rhino but want to learn more. Or, I must be honest, there was a couple that were like, hey, I can't go ahead and do any of that, but I've never got a chance to speak to you, and I want to just say hi, which is cool too, because everyone's offered everything that they believe. And it's my job to be a conduit, to be a sponge, to absorb it all, process it, and then make it going forward. And I think anyone here can understand very clearly that if we were able to go ahead and nurture the behavior that everyone in Rhino was able to go ahead and suggest 10, 15 other businesses, then what's the extrapolation of that, right? What exponent is that? So if I have one person in Rhino and they suggest 15 businesses, I now have 15 businesses. If each one of those businesses suggests 15 businesses, what's 15 times 15? We now have 225 businesses. If those 225 suggest 15, we now have 3,375. Then it goes to 760,000. Then it goes to 170 million. Now, do I think everyone's going to suggest 15 businesses? I don't. But what I'm very clearly seeing is each person on average could average to suggest in 5 or 6. I know that there's going to be people that are going to suggest 30. I know there's going to be people that suggest 0. I believe the average will be between 5 and 8. And if we can go ahead and get, say, 7, so 7 times 7, well, actually, so we have 1,100 right now. So 1,100 times 7 is 7,700. Times 7 is 8.4 million, which means I'm 2 exponents away from having almost 9 million businesses on Rhino Street. And the point is, that sounds like, whoa. And I agree with you. It's like, whoa. But just because it sounds too good, does that mean it is too good? Because this isn't an idea that I came up with. This is an idea that you came up with. You told it to me. I just have to be listening, and I did. So I'm going to make sure that this answer is one that I will ensure that I find out if it's correct or not. And the way I'm going to find out if it's correct is by overly incentivizing, rewarding, nurturing this, that if my son wants to play football, if I believe my son's going to be the best quarterback of all time, I don't know if he is or not, but I'm going to make sure that if he's supposed to be, he will be. You know how I'm going to do that? I'll throw the football with him every day. We will find our answer out pretty quickly, because we won't go ahead and find out that he could have, should have, would have, if only dad threw a football with him, right? So you are our children. I am your daddy. No, that sounds so weird. Michael, I try to be there. How about zip codes outside of the US for Rhino Street? So actually, a lot of people have, well, obviously, those outside the US that are part of Rhino Streets say, what about me outside the US? We are going to start in the US, but we're going to grow globally. We need to go ahead and catch our footing first in one market. And that's not to say one market's more important than the other market, right? But in anything you do, you cannot spread yourself too thin. You have to go ahead and focus on this, correct this, build the model to then share. That being said, every single person outside of the US, we still want you to list. In fact, it's important that you list. It's in fact that you put your zip code, because when we do grow to other markets, it's you we're going to reach out to. It's going to be to Michael in Sweden and say, hey, we want to grow in Sweden. We see that you are in Sweden. How can you advise us to best do that? How can we empower you to be our Swedish representative, right? Like there's still ideas to come, but for us to grow globally, we need to go ahead and have a foothold already in those countries, because all I know about Sweden is they produce the best music by Michael, which we're going to go ahead and email tomorrow for everyone to really, really see who some of our rhinos are. And Michael is seriously one of the most amazing. So I do want to share a little bit of him with you, but also that they do great massages. And I don't even know that to be true, because I never went to Sweden and got a Swedish massage, right? Thank you for clarifying it. I have a charity I want to advertise and based in the UK. Yes, we are going to allow everyone. And if it's left up to me, if God himself comes down and says, Ant, when do you want to go ahead and expand globally? The answer is ASAP. So if God said, all right, cool, America's done, I'd be moving to England and Sweden and all the other countries tomorrow. We have to get America done, because you got to remember, without having a foothold, without having a market that we're actually successful in, we can't grow. So one thing at a time. So that is our commentary for today. RHINOWealth has bled into Rhino Street, but as you know, it's all just one big family together. So I absolutely love all of you. I'm really, really actually quite flattered that we're at an hour and 8 minutes and only 2 people have left this entire time, which I suspect they got hungry, right? It couldn't be us. They were eating, their breakfast was done. So love everyone. And I will see you live Wednesday for the calls that I have this week. I will be on the phone with you, and you'll see the RHINOWealth email tomorrow. Bye, everyone.